Hi guys! Enjoy John's analysis.
Bitcoin is trading at $59,500 right now, down more than 50% from its October high. Before you watch one more second of this video, I need you to answer something honestly. Are you still holding because you have a thesis, or because you are afraid to admit you never had one? Do you check the price more than 5 times a day? Are you leveraged right now, even a little, even with money you told yourself you could afford to lose? Have you lost sleep over a position in the last 2 weeks? If you answered yes to any of those, this video is not going to comfort you. I am not here to tell you Bitcoin is going back up. I'm here to tell you who should never have bought it in the first place, and what to do if that person is you. There is a version of this video that sells you hope. This is not that video. This is the only exit plan that actually works, and it has nothing to do with price. By the end of this video, you will know the only 3 questions you should ever ask yourself before selling, and none of them involves a number. This video is for educational purposes only and is not financial advice. I'm not a licensed financial advisor, and nothing in the next several minutes should be taken as a recommendation to buy, sell, or hold any asset. Every number you hear is for illustration of a concept, not a forecast. Before we go further, I want to know who is actually watching this. Tell me 3 things in the comments below. Where are you watching from right now? What time it is where you are? And what the weather looks like outside your window. I read every single comment, and I want this channel to feel like a room full of people who think instead of react. So take 15 seconds, answer those 3 questions, and then come back to this. Because what I am about to teach you applies whether Bitcoin is at 60,000 or 600,000. Let me describe a person, and you tell me if you recognize them. This person bought Bitcoin without ever writing down in one sentence why they own it. They borrowed money or used leverage to make the position bigger than their savings alone would allow. This person checks the price constantly, sometimes during meetings, sometimes at 3 in the morning. They have not slept well in weeks, and they know it, but they tell themselves it will pass once the price recovers. They are not investing anymore. They are gambling, and they are calling it conviction, because conviction sounds better than confession. If that person is you, I am not going to insult you. I'm going to teach you exactly why you ended up there, what mechanisms in the market are currently punishing that exact behavior, and what to actually do about it. This is not a video about shame. This is a video about mechanics, because shame changes nothing and mechanics change everything. Bitcoin's current decline, more than 50% from its October peak, did not create these problems. It exposed them. A falling market is simply a stress test that every asset eventually runs on every participant. And right now it is running that test in public on millions of people at once. There is a particular kind of person this video is not for, and I want to name that group clearly so nobody wastes the next several minutes feeling judged when they should simply feel reassured. If you sized your position so that losing it entirely would be painful but not life-altering, if you can state your reason for owning Bitcoin in one specific sentence, and if your sleep and relationships have not changed because of a price chart, none of the warnings in this video are describing you, and you can watch the rest purely for the macro and historical context. But if even one part of that description made you uncomfortable, sit with that discomfort instead of clicking away from it, because discomfort right now is far cheaper than the discomfort of discovering the same lesson after liquidation has already taken the decision out of your hands. The market does not send a polite warning before it teaches this lesson the expensive way. It simply removes the option to choose, which is exactly why choosing now, while you still can, is the entire point of everything that follows. Here is the first thing almost nobody teaches before they teach you to invest. It is called risk of ruin, and it is the single most important concept in all of trading and investing, more important than any chart pattern or any prediction. Risk of ruin describes the mathematical point at which a loss becomes unrecoverable, not because the asset can never recover, but because your position size guaranteed that you could not stay in long enough to see it. Here's the intuition, without complicated formulas. If you lose 10% of your capital, you need to gain about 11% just to get back to even. That sounds manageable, and it is, but if you lose 50% of your capital, you do not need to gain 50% to recover. You need to gain 100% because you are now recovering from a much smaller base. If you lose 80%, you need to gain 400% just to break even. And most people who lose 80% never get the chance because they ran out of capital, conviction, or time before that recovery ever arrived. This is why professional risk managers talk about risking 1 to 2% of total capital per position, not because they are being cautious for the sake of caution, but because the math of recovery is brutally asymmetric. A small loss is linear to recover from. A large loss is exponential to recover from. Nobody explains this asymmetry to retail investors, and that omission is the actual reason most people blow up accounts. Not bad luck and not bad timing. Apply this to Bitcoin right now. If someone put their entire portfolio into Bitcoin at its October high near $126,000, and the asset is now down more than 50%, that person does not simply need Bitcoin to go back to even. They need it to more than double from here just to return to where they started, and that is before accounting for any money they borrowed to buy more on the way down. The bear case here is direct, and it deserves to be said plainly. If the macro pressures currently weighing on Bitcoin, which we will cover in detail shortly, continue or worsen, a position sized without any regard for risk of ruin can sit underwater for years, not weeks, and the person holding it may not have years of patience or years of capital runway available to them. Position sizing is not a boring technical detail you can skip. It is the difference between someone who can survive a 50% drawdown and someone who is forced to sell at the exact worst moment because they need the money for rent. The asset does not care about your timeline. Your position size determines whether you get to wait it out or whether the market gets to decide for you. There's a simple test you can run on yourself right now, and it takes less than a minute. Write down the dollar amount you have in Bitcoin today, then imagine that number cut in half again from where it sits right now. Not back to the October high, just half of today's already reduced value. If that imagined number changes how you sleep, how you talk to your family, or how you function at work, your position is too large for your actual risk tolerance, regardless of what your conviction level says it should be. Professional portfolio managers do not size positions based on how strongly they believe in an asset. They size positions based on the worst realistic outcome they can imagine, and then they make sure that outcome is survivable in practical daily life terms. Conviction tells you whether to own an asset at all, but it should never be the variable that determines how much of it you own, because conviction can be wrong. And a position sized on conviction alone has no protection built in for that possibility. Now, let's talk about leverage, because most people who use it do not actually understand the mechanism that will eventually take their money. Leverage means borrowing capital from an exchange or broker to control a position larger than your own funds would allow. If you use 10 times leverage, a 10% move against you does not cost you 10% of your capital. It costs you all of it. Here is the part almost nobody explains clearly. Liquidation is not a decision. It is an automated contractual event. The exchange does not wait for you to decide whether to exit, and it does not care about your thesis, your conviction, or your plan to hold long term. The exchange has a margin requirement, and when your account equity falls below that requirement, the position is closed automatically, instantly, often at a worse price than the market was actually trading at moments before, because the closure itself adds selling pressure into an already falling market. This is why leveraged liquidations tend to happen in clusters. One large liquidation pushes the price down further, which triggers the next liquidation, which pushes the price down further still, in a cascade that can move a market 5 or 10% in minutes with no new information at all, just mechanical forced selling. This cascading effect is sometimes visualized as a waterfall, and the comparison holds up better than most market metaphors do. Each liquidated position adds forced sell orders to the order book at exactly the moment the market has the least buying interest available to absorb them, because the same price drop that triggered the liquidation is also scaring away ordinary buyers who might otherwise have stepped in. The result is that leveraged markets tend to fall faster and recover slower than unleveraged ones, simply because of this mechanical feedback loop, independent of whatever the long-term fundamentals of the asset actually are. This is exactly the kind of environment we are in right now. A single-day move of 4 to 5%, which Bitcoin has experienced multiple times in the recent decline, is more than enough to wipe out anyone using meaningful leverage, regardless of whether their long-term thesis on the asset was correct. The market does not reward being right, eventually. It only rewards being solvent at the moment the bet resolves. The bear case for leveraged holders specifically is this. With spot Bitcoin ETFs recording roughly $6 billion in net outflows over 6 consecutive weeks, and with institutional buyers stepping back rather than stepping in, there is currently less large buyer support to absorb cascading liquidations than there was during the run-up to the October high. That means air pockets, sudden moves with very little resistance, are more likely right now than they were several months ago, not less likely. Let me walk through a concrete scenario so this stops being abstract. Imagine someone opened a leveraged long position using 5 times leverage when Bitcoin was trading near $70,000, believing the asset had found a bottom. A decline of roughly 20% from that entry point, which is well within the range Bitcoin has actually moved during this correction, would have wiped out that entire position, not gradually, but in a single automated event triggered the moment margin requirements were breached. The exchange does not send a warning that gives a meaningful window to react in most fast-moving scenarios. And even when it does, the person receiving that warning is often asleep, at work, or simply not positioned to add funds in time. This is why leveraged trading is sometimes described as borrowing time you do not actually have, because the position assumes you can react instantly to information at any hour of the day, an assumption that no human life can consistently meet. If you take one thing from this lesson, take this. Leverage does not just multiply your gains and losses, it changes the entire game from investing, where time is your ally, into trading, where time is your enemy. Because every additional day a leveraged position stays open is another day the market gets to test your margin requirement against unpredictable volatility. Unleveraged holders can simply wait. Leveraged holders are on a clock they cannot see and cannot control. Everything I just taught you about position sizing and the mechanics of leverage is also written out, step by step, with worked examples, inside the Bitcoin Holders Bible. It takes the math we just covered and turns it into an actual framework you can apply to your own portfolio. Not just a concept you nod along to and forget by tomorrow. On its own, it is $97. But if you stay with me until the very end of this video, I'm going to give you a voucher with $50 off. So keep watching, because what comes next is the part that actually determines whether someone should be holding Bitcoin at all. Now we get to the concept that separates an investor from a gambler who got lucky for a while, and it has nothing to do with intelligence or experience. It is the difference between a thesis and a narrative, and almost everyone confuses the two. A thesis is a specific, falsifiable claim about why an asset has value, structured so that real-world events could prove it wrong. A narrative is a story that feels true, that gets repeated enough times that it starts to feel like analysis, but that can never actually be tested against anything, because it was never specific enough to fail. Here are real theses that exist around Bitcoin today, stated the way a thesis should be stated. One thesis says Bitcoin functions as a scarce, censorship-resistant store of value because its supply is fixed at 21 million coins by code that cannot be altered by any single party. Another thesis says Bitcoin behaves as a hedge against currency debasement, gaining relative value when central banks expand the money supply faster than the real economy grows. A third thesis treats Bitcoin as a network adoption bet, where value should track the growth of users, infrastructure, and institutional integration over time. Notice that each of these can be tested. If Bitcoin is a debasement hedge, then a period of tightening monetary policy, like the shift we are seeing right now toward higher rates instead of cuts, should logically pressure the price, because the specific economic condition the thesis depends on is currently working in reverse. If Bitcoin is a network adoption bet, then sustained ETF outflows and slowing institutional accumulation should also be read as evidence against the thesis gaining strength in the near term, not just as noise to ignore. Now compare that to a narrative. Bitcoin always comes back is not a thesis. It is a pattern observation dressed up as certainty, and it tells you nothing about why this time would be the same as last time, because it never specifies the mechanism that would make recovery happen again. Institutions are going to save it is not a thesis either, especially right now when the actual data shows institutions doing the opposite, pulling roughly $6 billion out of spot ETFs over 6 weeks rather than adding to positions. The bear case here is uncomfortable, so I will say it directly. If your reason for holding Bitcoin was a feeling rather than a falsifiable claim, the current decline gives you no information at all, because a feeling cannot be tested and therefore cannot be updated. You will hold through any amount of pain, not because you have evidence the thesis is intact, but because you never had a thesis specific enough to know when it would be broken. This is the actual skill that separates people who survive drawdowns with their capital and their sanity intact from people who do not. It is not bravery, and it is not stubbornness. It is having written down in advance what would have to be true for you to be wrong, so that the market's behavior gives you actual information. Instead of just triggering an emotional reaction, you have to manage in real time. Here's a practical exercise you can do today, away from any screen showing a live price. Take a single sheet of paper and write one sentence describing exactly why you own Bitcoin. Then write a second sentence describing the one specific event that would prove the first sentence wrong. If you cannot complete the second sentence, you do not currently have a thesis, you have a feeling, and feelings are not built to survive 50% declines without significant psychological cost. This exercise sounds simple, almost too simple to matter, but very few people who hold this asset have ever actually done it. The ones who have done it are, almost without exception, the calmest people in any comment section during a decline, like the one happening right now, not because they are emotionally detached, but because they already know what would change their mind. And today's price action simply has not met that condition yet. Compare two people watching the exact same 40% decline. The first person says, out loud or in writing, "I hold Bitcoin because I believe central banks will continue expanding money supply faster than productive output grows, and I will reconsider if that pattern reverses for several consecutive years." The second person says only, "I believe in Bitcoin," with no further detail, and when pressed for specifics, repeats the same sentence with more emphasis rather than more content. The first person has something to check the news against. The second person has a slogan, and a slogan cannot be falsified, which means it also cannot be confirmed. which means the second person is not actually thinking about the asset at all. They are simply repeating a feeling back to themselves every time reality makes them uncomfortable enough to need reassurance. Let's talk about the macro mechanism that is actually driving a large part of the current decline, because understanding this teaches you something useful about every risk asset, not just Bitcoin. When central banks, particularly the Federal Reserve in the United States, signal higher interest rates ahead instead of cuts, the relative appeal of holding cash and government bonds increases compared to holding volatile assets that pay no yield. Think about it from the perspective of a large institutional allocator. If safe government debt pays a meaningful guaranteed return, the bar for taking on a volatile speculative asset like Bitcoin gets higher, because that allocator is now giving up a known growing return to take on an unknown one. When rate expectations shift from cuts toward hikes, as they recently have, that bar rises further, and the marginal buyer who used to step in on dips becomes less willing to do so. This is precisely what analysts have pointed to as a major driver behind Bitcoin's current weakness. Expectations shifted from rate cuts to a forecast of additional hikes in the year ahead, removing what had been a key pillar supporting institutional demand for risk assets generally. At the same time, a flood of capital is moving into artificial intelligence infrastructure, with major technology companies on track to spend several $100 billion in that sector this year alone, capital that is now competing directly with Bitcoin and other speculative assets for the same pool of risk-seeking money. There's also a quieter mechanism worth understanding, which is correlation. Over the past several weeks, Bitcoin has moved with a notably high correlation to gold, both reacting to the same set of inflation, rate, and uncertainty signals, rather than trading on anything unique to either asset. When that correlation is high and the macro backdrop turns negative, both assets tend to fall together, which is the opposite of what many holders assume, since they think of Bitcoin and gold as somehow insulated from each other or from traditional markets entirely. A stronger dollar adds another layer to this same mechanism. When the United States dollar strengthens against other major currencies, dollar-denominated assets like Bitcoin effectively become more expensive for buyers transacting in other currencies, which can quietly reduce global demand even when nothing about Bitcoin's own network or adoption has changed at all. Combine a stronger dollar with higher expected rates and reduced ETF inflows, and you get three separate headwinds pointing in the same direction at the same time, which is a meaningfully different situation than facing just one of them in isolation. The bear case is straightforward and it requires no speculation, just an honest read of incentives. As long as rate expectations stay hawkish and AI infrastructure spending continues absorbing risk capital at the scale it currently is, the macro tailwind that historically helped Bitcoin during loose monetary periods is simply not present right now. Anyone holding a thesis that depends on continued institutional inflows needs to be honest about whether that inflow is actually happening. And the ETF outflow data says, right now, that it is not. This is the lesson, stated plainly. Bitcoin does not trade in a vacuum, disconnected from interest rates, capital competition, and the rest of the financial system. It trades as part of that system, increasingly treated by large allocators as just another risk asset competing for capital, which means understanding rate policy is not optional homework. It is core to understanding why the price is doing what it is doing right now. This next lesson is not about psychology in the abstract. It is about a specific, observable mechanism, and I want to walk through it carefully and factually. When people make financial decisions under sustained stress and sleep deprivation, the quality of those decisions measurably declines, not because the person is weak, but because the part of the brain responsible for weighing long-term consequences against short-term relief does not function the same way under chronic stress as it does when well-rested. Here's why this matters specifically for leveraged or oversized positions. A person who is not leveraged and whose position size respects the risk of ruin math from earlier can genuinely walk away from the market for a week without consequence. A person who is leveraged cannot do that because their position can be liquidated at any hour on any day without warning, which means their nervous system stays on alert even while they are trying to sleep, even while they are at dinner with family, even during work. This is not a moral failing. It is a predictable mechanical consequence of the position itself, and it is one of the clearest tells that a position was sized incorrectly in the first place. If checking an app before sleeping and immediately after waking has become a daily ritual, that is not dedication to research. That is a nervous system responding to a threat that the position itself created. And the fix is not willpower. It is reducing the size or leverage of the position until the threat response stops being triggered by ordinary price movement. The bear case here applies regardless of which direction the market eventually moves. Poor sleep and chronic stress degrade judgment in both directions, causing people to sell in panic during drops they could have survived, and causing people to add risk impulsively during rallies they should have been cautious about. The current decline, with multiple 4 to 5% daily moves, is exactly the kind of environment that turns ordinary volatility into a sleep disruption event for anyone whose position size was already too large for their actual risk tolerance. If you take only one practical action from this entire video, let it be this one. Before you make any decision about your Bitcoin position today, ask yourself honestly whether you have slept normally this week. If the answer is no, the most disciplined thing you can do is reduce position size to the point where price movement stops affecting your sleep. Not because the market demands it, but because a rested decision and a panicked decision are not actually the same decision, even when made by the same person about the same asset. Let's finish the education with history, because Bitcoin's price history is actually data, not just a story people tell to feel better. This asset has experienced drawdowns of more than 70% from its highs on multiple separate occasions, including during the 2018 cycle and again during the 2022 cycle, each time accompanied by predictions that the asset was permanently broken. Here's the part that gets lost in retellings of that history. The people who survived those drawdowns with their capital intact were not the people who simply believed harder than everyone else. They were, almost without exception, the people whose position size meant a 70% drawdown was painful but not existential, and whose thesis was specific enough that they could distinguish between the price falling and the thesis actually breaking. During the 2018 decline, Bitcoin fell from near $20,000 to roughly $3,000 over the course of about a year, a decline of more than 80% that lasted far longer than most participants expected when it began. During the 2022 decline, it fell from near $69,000 to roughly $15,500, again over more than a year, accompanied by the collapse of several major lending platforms and exchanges that took customer funds down with them. Both periods produced a wave of public commentary declaring the asset finished, and both periods were followed, eventually, by recoveries that the loudest voices during the decline did not predict and often did not survive to benefit from. The people who did not survive those drawdowns, who were forced to sell at the bottom and never return to the asset, were overwhelmingly people who had ignored both lessons at once. They were oversized, often leveraged, and they were holding on narrative rather than thesis, which meant every new piece of bad news felt like a personal referendum on their identity rather than a data point to evaluate calmly against a predefined framework. History does not promise that the current decline resolves the same way previous ones did. That would be narrative thinking, the exact mistake we just spent an entire section identifying. What history does show, reliably, across multiple unrelated cycles, is that the mechanics of who survives and who does not have stayed remarkably consistent. And those mechanics are position sizing, leverage discipline, thesis clarity, and psychological sustainability, the exact 4 lessons we just covered in order. The bear case for this final lesson is the most important one in the entire video, so listen carefully. There's no historical guarantee that this decline ends in recovery on any particular timeline, or that it ends in recovery at all for every asset that has ever fallen this far. Some assets that fall 50% keep falling and survive as a smaller, diminished version of what they were. And pretending otherwise because of how previous cycles happened to resolve would be exactly the kind of unfalsifiable, comforting narrative this video has spent its entire length teaching you to recognize and reject. So here is the exit plan, the one promised in the title, and you will notice it has no price target anywhere in it, because a price target was never the right tool for this decision in the first place. There are exactly 3 legitimate triggers for exiting a Bitcoin position, and none of them are a number on a chart. The first trigger is that your specific written thesis has been falsified by real-world events, not by price action, but by the actual underlying condition your thesis depended on. If your thesis was a debasement hedge and central banks pivot to durable, credible tightening for years rather than months, that is a thesis breaking, and exiting on that basis is a decision, not a panic. The second trigger is that you discover you are leveraged, or that your position size is large enough that further decline would force a sale you do not control on a timeline you do not choose. That is not a market signal. That is a risk management failure that needs correcting immediately, regardless of what the price happens to be doing on the day you notice it. The third trigger is that the position is costing you sleep, costing you relationships, or costing you focus at work consistently for weeks rather than days. At that point, the position has stopped being a financial decision and started being a well-being decision. And no percentage gain in the future justifies trading away your present health and relationships to chase it. Notice what is conspicuously absent from that list. The price itself is not a trigger. Fear is not a trigger. What your friend, your group chat, or a stranger online is doing with their portfolio is not a trigger. If none of the 3 real triggers apply to you right now, then everything you are feeling today is noise that a correctly sized, thesis-driven position is specifically built to absorb without forcing a decision. Education without action is just entertainment, so let's close with something concrete you can do regardless of what the price does tonight or tomorrow. The first action is to calculate your actual current risk of ruin, using the simple math from earlier, and to write down what percentage of your total net worth, not just your trading capital, sits in this single asset right now. The second action is to check honestly whether any portion of your position is leveraged or borrowed, including margin from an exchange, a loan against other assets, or even credit card debt used to buy more during a dip. If the answer is yes to any of those, the most important task you have this week is not researching Bitcoin further. It is reducing or eliminating that leverage, because no amount of additional research changes the mechanical fact that a margin call does not negotiate. The third action is to write your one-sentence thesis and your one-sentence falsification condition exactly as described earlier, and to put it somewhere you will actually see again, not buried in a notes app you never reopen. Pin it above your desk, set it as a reminder, or write it on a card you keep in your wallet, because the entire value of a thesis is that you can return to it under stress when your emotional state is the least reliable tool you have for making decisions. The fourth action is to track your sleep for the next 7 days without changing anything else about your position, simply observing. If you notice a pattern of disrupted sleep tied to price checking, that observation alone is data, and data is what separates this exercise from the kind of vague self-help advice that tells you to simply feel calmer without giving you a measurable way to know if it is working. None of these 4 actions require you to sell anything today. None of them require you to predict where the price goes next, which is good, because nobody watching this video, including me, actually knows that with any certainty. What they require is honesty, applied consistently, which is a far rarer commodity in this market than conviction, and considerably more valuable. If you made it this far in the video, you already think in exactly the way the Bitcoin holder's Bible is built to reinforce. It takes every framework we covered today, position sizing, leverage mechanics, thesis construction, macro context, and turns each one into a worksheet you can actually fill out for your own portfolio, not just a video you watched once and forgot. As promised, here's your reward for staying until the end. Use the code DIAMOND50 at checkout, and the price drops from $97 to $47. The link is in the description below this video, and the code works for the next short window only, so use it now while it is fresh in your mind, rather than telling yourself you will come back to it later. I'm not going to tell you Bitcoin is going up or down from here because I do not know, and anyone who tells you they do know is selling you a narrative, not a thesis. What I can tell you is that the 4 lessons in this video apply no matter what the price does next, and the people who internalize them now will be in a stronger position than the people who wait for the chart to teach them the same lesson the expensive way. I see the diamond,